Listen, I want you to picture something real, not a hypothetical. A real American retiree on a quiet Tuesday morning in March of 2026. Sun City, Arizona, March 17th, 2026. 7:12 in the morning. Linda Parker is 67 years old, a retired school administrator, a widow, a grandmother, the kind of person who spent an entire career helping other people stay organized while rarely putting herself first. She is sitting at her kitchen table with a cup of coffee. The sunlight is pouring through the window. Outside, there is a small orange tree. Her late husband planted it years ago. Every spring it reminds her of him. The coffee mug in her hand says, "World's Best Nana," a gift from her first grandchild. It is one of those ordinary mornings retirees dream about while they are still working. Quiet, comfortable, predictable. Linda did everything right. She contributed to her 401k year after year. She delayed claiming Social Security because experts said patience would pay off. She paid off her mortgage. She worked with a CPA every tax season. She avoided reckless investments. She followed the rules. Every rule. Then she opened the mailbox. Inside was a Medicare premium determination notice. At first she thought it was routine paperwork. Most retirees would. Then she started reading, and her stomach dropped. The notice informed her that her Medicare premiums were increasing substantially because of income reported from a prior tax year. The annual increase? $4,932. Nearly $5,000. Gone. Not because she earned more this year, not because she changed health plans, not because she broke a rule, because Medicare looked backward. 2 years backward, and what it found changed everything. Linda stared at the letter. Then she stared at the orange tree. Then she stared at the numbers again. The numbers did not change. The bill was still there. The increase was still there. And the explanation was buried inside language most retirees never read until it is too late. For what? One income event. One financial decision. One invisible line. A line she did not even know existed. And that is exactly what makes this story so dangerous. Because Linda is not unusual. She is normal. Millions of retirees are walking toward the exact same line right now without realizing it. Many believe crossing a certain income threshold simply means paying a little more tax. That is not always what happens. Sometimes Medicare starts looking at you differently. Sometimes your healthcare costs change. Sometimes a financial move that looked smart at the time creates consequences years later. This is not about punishment. This is about understanding the rules before the rules surprise you. This is the invisible income line, and I am about to expose it. Welcome back to the archive. I am the retirement insurgent, and today we are tearing the roof off one of the most misunderstood Medicare rules in America. Most retirees spend decades preparing for retirement income. Almost nobody prepares for how Medicare measures that income. And that distinction matters more than most people realize. Before we go 1 inch further, I need you to do something. Smash that like button right now. I am not asking, I am telling. Because retirement education often gets buried underneath celebrity news, political outrage, and endless entertainment content. If you believe Americans deserve to understand the rules governing their retirement, hit like right now. It helps more retirees find this information before they receive their own surprise letter. And subscribe, ring the bell, join the archive, because retirement rules change, thresholds change, planning opportunities change. And if you wait until the notice arrives, you are already reacting instead of preparing. Now, the lawyers would like me to remind you of something important. This is education, not financial advice, not legal advice, not tax advice. Rules change, individual situations differ, and you should always consult qualified professionals before making major retirement decisions. Think of this video as a roadmap, not a personal recommendation. Now here is what you are going to understand by the time this video ends. First, the specific Medicare income thresholds that matter. Second, the 2-year look-back rule that catches retirees off guard. Third, several legitimate planning strategies that may help reduce future IRMAA exposure depending on your circumstances. And trust me, the second part of this story is where things get interesting, because the income Medicare looks at is not always the income retirees think it is. Most retirees believe Medicare only cares about taxable income. That sounds reasonable. Unfortunately, reality is more complicated. Medicare uses a measurement called Modified Adjusted Gross Income, MAGI. And under current rules, Medicare generally reviews income from 2 years prior when determining certain premium adjustments. That means decisions you make today can influence healthcare costs years later. This is where confusion begins. After studying Medicare premium adjustment notices, IRS income definitions, and federal guidance across multiple years, The pattern is unmistakable. Retirees often focus on this year's income while Medicare is examining a completely different year. Look at the dirty legal trick they use. The system is not primarily looking at how much cash feels available to you. The system is looking at specific income measurements reported on tax returns. And that distinction changes everything. Let me do the math live so it lands. Meet Robert, age 68, Florida resident, retired. His annual pension provides $55,000. Social Security provides another $36,000. He takes a $50,000 IRA withdrawal. Nothing shocking so far. Then comes one additional event. Robert sells an investment and realizes a $70,000 capital gain. Now watch carefully. Look at the dirty math here. $55,000 pension income, plus $36,000 Social Security, plus $50,000 IRA withdrawal, plus $70,000 capital gain. Total income measured for the relevant calculation rises significantly. One transaction, 1 year, one unexpected jump. And suddenly Robert may find himself in a different Medicare premium category than he expected. That does not automatically mean disaster, but it does mean consequences. Consequences many retirees never saw coming. This should make you absolutely furious. Not because the rules exist, but because so many people discover them only after the fact. Most people assume this happened by accident. It didn't, because when we look at how these thresholds evolved, we discover a much bigger story. And that story begins with the people who designed the system. So who designed this? Who decided that two retirees with similar lifestyles could end up paying different Medicare premiums because of income measurements from years ago? The answer is not mysterious. Congressional legislation, Medicare funding reforms, budget policy decisions made over many years. The roots of IRMAA stretch back to the early 2000s. Over time, lawmakers expanded income-related premium adjustments as part of broader efforts to manage Medicare funding and federal spending. In plain English, higher-income retirees were asked to pay a larger share of certain Medicare costs. Whether you agree with that policy or not is a separate conversation, but understanding it is essential, because you cannot prepare for a rule you do not know exists. The system is designed to charge different people different amounts based on income measurements that many retirees never fully understand. Not because Medicare knows how wealthy you feel. Not because Medicare knows your monthly budget. Not because Medicare knows whether you are helping grandchildren through college. The system looks at reported income, period. And that single fact changes the entire game. Who benefits? First, Medicare funding programs receive additional contributions from higher income beneficiaries. Second, federal revenue collection improves because more costs are shifted towards certain income groups. Third, budget planners gain another mechanism for controlling long-term program expenses. Who loses? Retirees who never knew the rules existed. Retirees who make one large financial move without understanding the future consequences. Retirees who accidentally trigger a premium increase they could have planned around. This should make you absolutely furious. Because the issue is rarely the rule itself. The issue is that most people discover the rule too late. Now watch what happens next, because this is the part that should make you absolutely furious. 3 states, 3 completely different realities. Let's start with California. California retirees often face a combination of federal planning challenges and state tax considerations. A large capital gain can create consequences beyond what many retirees initially expect. Now look at Texas. No state income tax, completely different planning environment. The federal Medicare rules still apply, but the overall tax picture can look very different. Now consider New York. Many retirees there navigate layered retirement income decisions involving investments, withdrawals, and estate planning considerations. 3 states, 3 completely different realities, same federal Medicare framework, different tax environments, different planning opportunities, different outcomes. And that means your location matters more than many financial commentators admit. Tell me in the comments right now, what state are you retiring in? And have Medicare costs ever surprised you? I read the comments. The archive learns from each other. Your experience could help another retiree avoid an expensive mistake. And if you know someone approaching Medicare age, send this video to them. Not tomorrow, today. You are not sharing a video. You are sharing a warning. Because what comes next is where the real solutions begin. Save this video right now. This is your survival manual. When retirement planning gets complicated, you want this information available immediately, not 3 weeks later, not after the notice arrives. Now let us get to the strategy, the actual playbook. Strategy number 1, the Roth conversion timing strategy. Many retirees hear about Roth conversions. Far fewer understand the timing component. A Roth conversion can sometimes be useful because future qualified withdrawals may be tax-free under current rules. But timing matters. A large conversion performed in a single year could potentially increase income enough to affect future Medicare calculations. That does not mean Roth conversions are bad. It means planning matters. Smaller, carefully planned conversions may create different outcomes than one large conversion. The strategy is not about avoiding action. The strategy is about understanding consequences before taking action. Strategy number 2, the income smoothing strategy. This concept is simple. Avoid stacking multiple large income events into the same year whenever possible. Imagine selling appreciated investments, taking large IRA withdrawals, and completing a Roth conversion, all in the same tax year. That combination could create an income spike. Instead, some retirees work with qualified professionals to spread events across multiple years when appropriate. The goal is not perfection. The goal is predictability, because predictable income is easier to plan around than sudden income spikes. Oh, friends, it gets so much worse. Many retirees spend decades building wealth, then accidentally create problems by concentrating income into one year. Not because they were careless, because nobody explained how the moving pieces connect. Strategy number 3, the qualified charitable distribution strategy. For eligible retirees, QCDs can sometimes provide a way to satisfy charitable goals while influencing taxable income calculations. Again, this is not appropriate for everyone, but it is one example of how understanding the rules creates options, and options create flexibility. Now let me give you an analogy. IRMAA is like a motion-activated floodlight. You can walk through the yard unnoticed for years. Then one unexpected movement suddenly lights up the entire property. The floodlight was always there. You just did not know where the sensor was located. That is exactly how many retirees experience Medicare premium adjustments. Now, I want to be completely honest about the risks here. Every strategy has trade-offs. Every retiree has unique circumstances, and every planning decision should be evaluated carefully. After studying retirement income planning guidance, Medicare premium adjustment rules, and tax treatment examples across multiple years, one pattern is unmistakable. Retirees who understand the rules early usually have more options than retirees who discover them late. Knowledge creates flexibility, and flexibility creates choices. Let me show you 2 versions of the same retirement. Same retiree, same assets, same opportunities. Different decisions. Linda Parker, age 67. Retirement portfolio worth approximately $920,000. Annual Social Security income of $40,000. Mortgage-free home. Type A. No planning. Linda sells a large appreciated investment position. The gain is realized in one tax year. Income jumps. The gain combines with existing retirement income. Several months later, she discovers the transaction contributed to a higher Medicare premium category. Nothing illegal happened. Nothing reckless happened. But the planning never happened. Now let's look at Type B, the insurgent plan. Same Linda, same assets, same retirement. But before acting, she evaluates the timing of withdrawals and investment sales. She understands how income may be measured. She coordinates major transactions carefully. The result? Potentially lower income spikes, potentially fewer surprises, potentially lower Medicare-related costs. Again, outcomes depend on individual circumstances, but awareness changes possibilities. In our illustration, the difference amounts to several $1,000s over the adjustment period. Not life-changing wealth, but meaningful money. Money that stays available for travel, family, healthcare, or simply peace of mind. Same retirement, same assets, different planning structure, thousands of dollars apart. That is the entire game. Here is what you are going to do tonight. Not next week, not after the holidays, tonight. Step 1, locate your most recent tax return. Not your estimate, not your memory, the actual document. Step 2, calculate your current modified adjusted gross income. If you are unsure how, write it down as a question for your tax professional. Step 3, review any planned withdrawals, asset sales, Roth conversions, or major income events you expect in the next few years. Step 4, ask yourself one question. Could any of these events create an income spike that Medicare may eventually review? Remember, the 2-year look-back rule means future Medicare costs can be influenced by decisions made today. That is why planning matters. You do not need to become a tax expert. You simply need to become aware. Awareness is often the difference between preparation and surprise. Tell me in the comments which step you are starting first. And tell me your state. The archive becomes stronger every time retirees share information. If this video could save a friend or family member thousands over retirement, send it to them tonight. Not tomorrow, today. You can be the retiree who discovers these rules after receiving the notice, or you can be the retiree who understands the rules before the notice arrives. The choice is yours. The reality is simple. Retirement planning is no longer just about saving money. It is about understanding the systems connected to your money. The more you understand those systems, the more options you typically have. And options matter, especially in retirement. Smash that like button one more time on your way out. Help this information reach the next retiree who thinks Medicare only looks at current income. Subscribe, turn on notifications, join the archive. Because next time, we are exposing the widow's tax penalty that catches thousands of retirees completely off guard every year. You do not want to miss that one. Until next time, stay informed, stay protected, stay one step ahead of the system. I am the retirement insurgent, and this was the archive.